Yeah, no, that's the aggressive timeline to open the bar.
Wait, you're opening a bar? What do you mean you're opening a bar?
Yeah, with some other people, maybe even with you.
Wow.
No, but in Lincoln, yeah, we're starting. There's going to be a bar with the Drunkenomics guys working it.
Oh my gosh, I can't believe we're having a semi-official Drunkenomics bar.
Yeah.
What are we calling this thing again?
It's going to be the Post.
The Post. Yeah. Where's it going to be?
In the Telegraph District in Lincoln. So it's by the spring, this summer.
So which part of Lincoln is that? Is this like?
It's just east of downtown, like right at Antelope Valley Parkway, right next to the mill.
So good old Lincoln, Nebraska is going to have a little Drunkenomics bar, huh?
It's going to have the official Drunkenomics bar, yeah.
Wow.
Weird, right?
I know. That's like weird to say.
Are
we announcing? Are we live right now?
I mean, it's not a secret.
Are you 2 shots in?
Oh, yeah.
Then we're live, baby. Did you know that over $5 trillion exchanges hands on a daily basis? That's an average of over $220 billion an hour. Now, how does this much money move every single day, and why does it move the way it does? Here on Drunkenomics, 2 bartenders who also happen to be students at the University of Nebraska Graduate School of Business are going to sit down and drink to the global economy and try and translate it into English. So sit back, relax, pour yourself a stiff one, and have a drink with us to the comedy that is the global economy. All right, everybody, and welcome back to yet another presentation of Drunkenomics. This is the drinking podcast with an economics problem. So glad you all can join us. If this is your first time, welcome. And if you've been to one of these presentations before, well, welcome back. So glad that you can join us for another drink. Hopefully you have a stiff one in front of you, unless you're about to drive. In that case, be responsible. Yeah, wait till you get to where you're going. And then once you're done, then you can have your nightcap. But either way, I think we have a pretty exciting presentation. I don't know. I like to think all of them are, but then again, you never know. You never know how sloppy we get after a few jams of whiskey. But either way, I'm also a little bit bitter right now because I'm welcoming us back as a less gracious host. The VIX, in its efforts to spite me, is still well above 18. It's at 22.86. So I, this week, once again, am the less gracious host. My name is Aaron, and I'm joined alongside the ever so gracious, with my effervescent grace, with being the more gracious host. I'll just go by James this week. Okay, James, just James, leaving out the Goldwater.
I am James the MGH.
To be honest with you, I think your last name is a really good nickname for Scotch. Goldwater. It's Goldwater. It's Scotch.
Fair enough.
I can think of worse nicknames for Scotch. Just saying, not bragging, just saying. But once again, so glad you all could join us. And if you want to join us for some more content, you can always find us on social media at Drunkenomical, DRUNKENOMICAL. Did I do that okay?
Sounded correct. It's spelled right.
Yeah.
But you can track us down on Twitter. Wow, no. Twitter, Instagram, Facebook.
Wow.
Yeah.
Were you trying to combine the word Twitter and Meta?
I was.
To combine Twitter, Instagram, Facebook? Yeah.
So Twitter, Instagram, Facebook. And there you can find invites to our Discord where you can join us, ask questions, just hang out with us.
You can make fun of our snarky tweets.
For any of our European listeners, what I'll say is you can find us on Meta while supplies last. I don't know if, given the news Facebook's putting out or Meta's putting out today, who knows whether they're still going to be in Europe in a few months, but
yeah, exactly. That's a pretty interesting thing. I can't believe they're thinking about getting out of that. And as a matter of fact, what I kind of want to do, I might do this, I might not. So I just want you to know, just so I don't seem flaky, I might do a little op-ed for this on, by the way, nice shot glass, on our LinkedIn page and or on our Facebook page or on our blog. Our blog still sucks,
but we're working on it.
Yeah, I'm working on it. I mean, there's articles there. But the layout still sucks, and I have no idea what I'm doing on that thing. And I feel like I never ever thought in my life I would ever start a blog, let alone a podcast, but blog more so. And
absolutely,
yeah. And I figured, why not? It was a recommendation from a friend saying this might be a good thing. I have a journalism degree, so why not try and use it? Does that make sense? I paid a lot for it. I mean, I know I didn't. I golfed a lot for it.
I golfed a lot for it.
Yeah, so I don't know. Maybe you can make fun of my journalism skills. If you're in our Discord, if you follow us on Twitter or whatever, you can say, that Aaron guy does not know how to write. But whatever. You can find our longer form content in there. It's blogging style stuff. Most of it's like a 1-minute read. It's there for you if you want to consume it. If not, I guess we'll just get right to it.
Easy.
Yeah, we'll just start talking about Facebook exiting.
Yeah, Facebook's theoretically exiting the European market. So there's new laws being drawn up, new regulations on how much information can be transferred to the United States.
Yeah.
The people on Facebook and on Instagram in Europe. And so Facebook's considering withdrawing from that market. And I'm not saying that's the worst idea I've ever heard, but it's pretty close.
I know, but it's more, I feel like it's really just a power play. It's Facebook going like, okay, fine. If you don't want to provide us with this kind of information, if you don't want
I'm going to take my ball and go home.
Yeah, because it's Facebook. I mean, if you're not the consumer, you're the product. So, there's all these products in the UK that Facebook doesn't have as much access to that they would like. It's just that sounds weird saying.
Yeah, no, it's
that's pretty much what it is. I think
it's very much just Facebook and Instagram being like, hey, we're just going to leave if you don't give us what we want.
Yeah.
It's like, well,
I
don't think Europe as a whole is going to be like,
yeah, I don't think there's any winning for this on Facebook because I don't think Facebook has that much leverage. But I do think people in Facebook, but I do think people in the UK, people in Europe do enjoy using Facebook. They do enjoy having Facebook.
I think they do, yeah.
But I think as a whole, they'll find something else.
Yeah, I'm not unconvinced that social media will not. Yeah. They won't find a way.
And I also don't think that Facebook is going to say, all right, well, we're going to leave the UK and all of Europe because you guys won't give us this information. Like they still have plenty of information to send targeted ads for. Oh, they still have a giant market there. So why would they ever want to leave that? So
yeah, it seems really short-sighted.
Yeah, it's like the kid taking the ball from the court and just going home. But
I think I know this kind of breaks up the momentum. It's time for a question.
I was actually trying to think of a way to segue into that, but you just did the hard segue. So let's do it.
I'll do the hard pull. Not subtle at all. We got a question in the
not subtle like tequila.
Let me tell you about mezquila. That's what Saturday night was really rough, guys. Yeah. I drank mezquila, which is mezcal tequila mixed. I'd strongly advise against it. I don't care that Guy Fieri's on the cutout on the bottle. Don't do it.
I didn't know that was a thing that people do. Wait, it's a single bottle that you buy, and it's a mixture of tequila and mezcal.
It's not good.
Speaking of which, fun fact, I know this has nothing to do with the question, and this is the worst hard transition ever.
Actually, no, I think this is a perfect time to talk about this question.
What I was going to say is tequila is now the most popular liquor in the U.S., but that's just because of the demand for it, right?
I mean,
the demand for it, So speaking of which, the question.
From frustrated.
Yeah.
Are you guys demand side economics or supply side, or does it depend on what you're dealing with?
I mean, this is a weird answer, but I'll say both. But if I had to pick one,
I would say 95% of the time I'm a demand side guy.
But it's both. It's both.
There's a few times where supply side makes sense. So, and for me, that's very specific things like fire extinguishers and smoke detectors. It's okay. You have to make them inexpensive because you want people to have these. So if it's something that you decide as a society you want people to consume, you go to the supply side. For most of the rest of things, it's demand side only to me.
Yeah, just because
there's no demand for smoke detectors.
Yeah, I mean, to me, it's just like just because it exists and just because there's a business in making a certain product doesn't mean that it's going to drive consumers to that product. Just because it's there, no one's going to buy it because it exists. It's going to be something that people want.
That's why I think mezquila, I don't know who's in charge of it, but let's put it this way. There's no demand from me, but there's a supply from someone.
But there's also a giant demand because, like I said, not mezquila, but tequila in general is the most popular spirit in the U.S. now, apparently.
There's a demand for it, and the supply is dry. Yeah. But when you have new products going to market, well, is there a demand for it?
Yeah.
Let's find out.
But then again, I mean, it's kind of like crypto, right? Like, I mean, the demand for crypto is massive. And I know you're kind of rolling your eyes right now, James. And I'm sorry to have used this as an example of all the things I thought of. I don't know why I thought of this one.
I just hate crypto. I think that's just all we've got to say.
Yeah, I know nothing bothers you in the world more than cryptocurrency. But
there's a few things.
Mezquila, such as. But
now.
Yeah. But no, I like if you look at like the blockchain technology, you look at a company like Coinbase, if you look at even Robinhood, I mean, look at all these industries around cryptocurrency that have become insanely popular and liquid and profitable. It's all because of this crazy demand for crypto. I mean, there's a whole industry towards that blockchain technology, and it's all really started just with crypto.
There's huge demand for Bitcoin. There's lesser but also large demand for Ethereum. Yeah. I'll be honest, there's a lot less demand for like Deep Onion and Dogecoin, and
but it doesn't matter. I mean, it's just like the fact that there's so many people wanting to be a part of that. And NFTs and all that kind of stuff. I mean, there's massive industries, billions of dollars in that industry because of the demand and nothing else. The demand, once the demand leaves, it's gone. There's nothing there.
Yeah, so, I think demand drives an economy as a whole. I'll say I'm a demand side guy. Demand drives an economy substantially more than supply does, and only because look, you can put out as many wired corded telephones as you want right now into houses or payphones. You can have that supply there. No one wants them.
Yeah,
so there's no point. People didn't know they needed a computer in their pocket until the iPhone.
Yeah, exactly. And then look what that did for demand. Look what demand did to houses in 2008, or I guess let's say 2006.
2000.
And right now.
22.
Exactly. Yeah. Which this kind of leads into, hopefully they answered your question, but this kind of leads into home buyer sentiment is down.
Are you telling me that right now with housing prices at their highest is a bad time to buy a house?
Wouldn't you believe it? Yeah. I mean, if you didn't love it at 500,000, you don't love it at 510,000. Let's just say that much.
That's absolutely right. I don't know why you think I should be paying 500,000 for this shed, but I'll be honest, I'm not gonna.
Yeah. But anyways, January housing sentiment, it's at its lowest levels since May of 2020. It's about do you know how they measure that? I have no idea how they measure that.
That's the interesting question is
but it's also like any other sentiment measurement, right? Like
they essentially
what does consumer sentiment mean? How do they measure that?
They ask people. It's that weird point where it's like, okay, they're asking people. Well, who are you asking first off?
Yeah. Are you asking poor people? Are you asking rich people?
Basically, the big one is it's Fannie Mae.
Oh, they do the surveys?
Provides this. So Fannie Mae does the survey. And what I'll see is, so one of the senior VPs out of Fannie Mae said younger consumers more so than other groups expect home prices to rise even further, and they also reported a greater sense of macroeconomic pessimism.
Okay, yeah, so that absolutely 100% makes sense, because if you ask anybody my age, nobody wants to buy a house right now. Nobody wants to, because
he said, while the younger respondents are typically the most optimistic about their future finances, this month their sense of optimism is declining.
Yeah, well, I got to be honest with you. It's about time that people my age, I'm 27 years old, are starting to actually view things on a macroeconomic level kind of more similar. This macroeconomic pessimism, finally, like they're on my side of the fence now. And I'm just like, the pettiness is so fun.
Yeah, no, guys, join us. It's a lot easier here where you don't try to hope for the best, where you just go, we're
all screwed. Maybe not
pretty bad out here.
Yeah, it's
screwed might be too strong a word.
Yeah.
Maybe it's not a strong enough word.
Exactly. We don't know.
Let's take a healthy dose of realism to the world around us.
Because where is this optimism coming from? What is the catalyst for this? There isn't any. I mean, at least right now there isn't. But whatever. Hopefully it comes around. But home buyer sentiment. It's down 5.9 points. What is it? I don't even know what that means. So the home buyer sentiment is at 71.8 points in January. I don't know what that means.
Yeah, I don't know how they're meant.
But apparently,
what I'd say is this:
it's not negative. I guess which is a good thing.
No, it's just falling. It's not it is decreasing. Sentiment is what it boils down to is this: if you look at what they're saying, 15% of 18 to 34-year-olds think it's a good time to buy. 83% think it's a bad time to buy.
Oh, okay. So that makes sense. I don't see why people would think it's a good time to buy. To me, home prices, I think, they're a good pulse in the economy, but at the same time, it's also like, when it comes to home prices, there's one of two things you're paying a lot for. You're either paying a lot for equity or you're paying a lot for interest.
It's not interest right now.
That's why I think but then again, prior to this, there was no interest in home loans either.
Well, I would say housing prices are at an all-time high. Housing inventories are at an all-time low.
Yeah, demand, there you go.
Maybe an all-time low, but a huge low. Supply, yeah. So there's a low supply, a high demand. Major hedge funds and Wall Street firms are moving into the purchase of residential property. So you're seeing people getting priced out and going, I'm not going to be owned by a house.
Yeah, I mean, people like parking their money in real estate when they're trying to protect it from inflation. But speaking of which, that's going on right now as well. But
to be fair, if we look at, even Canadian regulators, one of the major Canadian banking regulators said what their expectation is that home prices are going to fall 20% in Canada during the quantitative tightening to come. And so, if you expect home prices to fall, I wouldn't buy now either.
Yeah, exactly. And I think that's what people are expecting. Like, okay, as rates are going up, you're going to be paying less for equity, but you're going to be paying more for interest.
Yeah.
I don't know. Does it even out? Maybe it does. Maybe it doesn't. It just depends how much of a reaction there is based on the previous reaction. It's kind of like physics. I don't know. Does that make sense?
Yeah. No. I've got a scale, and I'm going to be paying more in interest, but I'll be paying less. I'll be paying for less house.
Yes.
Or paying less for the house. So it's one of those things where it's like, maybe I wait for home prices to make sense. Let's put it that way.
So I thought that was pretty fascinating. Other economic news, in case you're wondering, January jobs report came out. Actually, not bad at all. Non-farm payrolls up about 467,000.
Beating expectations, which was
by quite
good.
a bit. It beat expectations by quite a bit. Even the highest expectations were 210,000, an increase on non-farm payrolls, and it blew the highest expectations out of the water. Yeah,
and then they amended December's long-term unemployment rate down.
Yeah, which is awesome. That's fantastic. That's great news.
Which, it says it tells me the economy is stronger. Than,
I mean, it's kind of like when
is in a strong position or a stronger position.
Yeah, it's kind of like when Jerome Powell gave that statement. He said the labor market is strong. I mean, he's not kidding. The labor market is really strong. Unemployment rate is a little bit high, but I think maybe it's a lot of people graduating from December, right, and entering the worworkforce in January.
It was 4%. They expected 3.9.
Yeah, which is
okay.
Yeah, I mean, it's really not that bad. And it was 3.9% in December, so it went up a 0.1%, which is a lot of people. I get it, but more people entering the workforce. I think workforce participation is up a little bit more.
I mean, salaries are up 5.7% year over year. So
exactly.
Another great reason for unemployment to go up is that you find out that the place that's another place near you pays more money than the place that's currently paying you, and you asked your current employer, "Hey, pay me more money." They said no. You quit and went and got a job at the other place, and you left. You're unemployed, and then you're employed. That's it's called transitional unemployment, folks, and it's
But at the same time, like the labor force participation also went up. So when that goes up,
more people are coming back in
to the unemployment rate. So Jerome Powell is right, man. He's not kidding. The labor market is strong. Fed does need to actually.
It's gonna have to raise rates. That's where we're at. I'm still happy sitting on my 50 basis points.
Really? Okay. Do you want to make a bet, me and you? Because I think it's only going to be 25.
You think it's going to be 25 7 times this year?
No. I'm saying just for March. Like I'm not saying for the rest of the year. I have no idea. I mean, so much can happen. Who knows?
How about we bet that Bush Light?
Oh no.
From Bama, Georgia.
No, I'll still give you that Bush Light.
Fine, then I'll get you a Bush Light.
No. Let's do a Bush. Let's do a Bush Mills. Want to do a Bush Mills?
Agreed.
Anything above 25, you get a Bush Mills.
Okay.
Anything below, I'll
definitely take that.
25.5 is our line.
Okay. I still think it's 50 basis points. I think we go from 0 to 25 basis points to 50 to 75 basis points in March.
Okay, yeah. So if they do 50 basis points, I will get you a Bush Mills and a Bush Light.
And if it goes the other way, I will buy you a Bush Mills and you will buy me a Bush Light.
So this has been broadcast to
Don't worry, we'll take pictures.
Yes, exactly. I don't welch, so I mean, just saying, not bragging, just saying I don't welch. So yeah, that's economics news. And the other thing is merger Mondays are back. So
and apparently acquisition rumors are abound as well.
Well, I mean, remember there was a time where like every Monday it seemed like there was a big merger or a big spinoff, like whether it was GE spinning off a bunch of companies or AT&T, Time Warner, or Microsoft, Activision Blizzard, and then today we had Frontier and Spirit Airlines. Yeah, exactly. So that just happened.
They declared
how
intent
big
to
was
merge.
the deal again? Is it 6.6 billion? I'm pulling it up here. It's coming to me. 6.6 billion. That's what it is.
Yeah.
So they're going to be.
It's not insubstantial. It would make them
the fifth biggest and
fifth largest airline.
So they'd be right behind. Who'd you say is number 4 or 5? I thought Southwest
they'd be right behind.
4.
So in the U.S. They'd go just behind United because it's American, Delta, Southwest, and then United in terms of the people carried.
Yeah. Well, I really thought Southwest is number 4, but
that's in terms of fleet size. They're number 4.
Okay, so market cap, not the same story. Gotcha.
Well, I'm talking about number of talking about number of passengers carried. Is how
not size of the company. Yeah, I got you.
Yeah.
So now they're the 5th biggest in the world, or not in the world, in the U.S.
If the merger is signed off on.
Yeah, exactly. So it's not insignificant. Obviously, I feel like both of these companies kind of got kicked in the teeth a little bit from COVID. Obviously, if you fly planes, if you travel,
it wasn't a great time for you.
Yeah, that entire sector just got wrecked during COVID.
And other breaking, I mean, if we want to do some other breaking news on mergers that didn't work out, Nvidia's acquisition of ARM from SoftBank has apparently blown up. That's not going to happen. So they announced this in 2020. Nvidia was trying to acquire ARM. ARM is a UK-based firm that designs a lot of chips. That's their whole thing, is that they design.
I thought they were Japanese, or is their parent company Japanese? And
SoftBank
Nvidia,
is.
So Nvidia was trying to buy it from That's right. So they're trying to buy it from SoftBank, which is a Japanese company, and they just withdrew their offer?
No, so
or was it
in December, so just 2 months ago, the FTC sued to block the acquisition,
geez.
arguing that competition in chip markets for chips and self-driving cars and other categories would be hurt if this was done. There were also British and EU regulators that had concerns that this would drive up prices and reduce choice and innovation. And with this news that Nvidia will not be acquiring ARM from SoftBank, apparently ARM is set to IPO.
Wow. Okay. So they're just going to be
ARM is going to be totally spun off from SoftBank and is going to go public.
So they were trying to find a suitor, and now they're just like, okay, well, the secondary market, they seem like a pretty good suitor.
Yeah, that's what that looks like.
Wow. That's pretty fascinating. So, I mean, merger news all over the place. I pulled up a list of mergers. I didn't even know about half of these. I mean, these mergers are massive. I remember seeing the Take-Two and Zynga merger, Oracle and Cerner. I remember seeing all those, but there's so many mergers.
Acquiring Activision.
Yeah, I remember seeing that one. But there's so many mergers. So I figured after all these merger Mondays, why not have a merger Monday, like a full-on mega cap merger Monday today? And let's just talk about mergers, because why not? Mergers are fun.
Mergers and acquisitions, yeah.
Yeah.
I guess we should say mergers and acquisitions, they are two slightly different things that have the same effect in the end, essentially.
Mm-hmm.
Merger being two existing companies agree to form a single new firm.
Yep.
Acquisitions are where one company acquires another company and takes over all of its assets, buys it out, essentially.
All of its employees, if they want it.
Mergers are a marriage. Acquisition is a purchase.
Mergers and acquisitions. I mean, so let's talk about mergers. What are they? Basically?
Well, they're all a little different. So it all depends on what kind of a merger we're dealing with. There's a conglomerate merger, which is where two companies with unrelated businesses come together to form a single company. That's one. It's just they come together and they're like, okay, we think we can improve each other. So you might have
it'd be like I feel like it's like a mortgage company buying a real estate company.
Yeah, or so think about it this way. When Walt Disney merged with ABC.
Oh, okay. Yeah, so there you go. That's a prime example.
Movies and theme parks married television.
Yeah, gotcha. So why would a company want to merge or get acquired?
Well, the reason to merge is that you might see that you might be in very different business fields, but that working together you can have a synergy that makes you better than anyone else. So there's a profit motive there.
Uh-huh.
With other mergers, if you guys are in the same field, you might sit here and say, look, we're both too small to compete. We're both so like Spirit and Frontier might be sitting here saying, look, there's no point in trying to compete with each other. Let's merge.
Yeah.
We'll pool resources to keep doing what we're doing. And then since 500 flight routes overlap between the two of them, they can stop waste. They can pick up new flight routes, or they can be more efficient in their current flight routes.
Right.
So you might have these companies that do the same thing, saying, okay, let's work together to be more efficient. Let's work together to pool our resources to do this job better.
And that's the other thing about the airline industry is
you purchase your routes, you control your routes,
which is ridiculous.
So it's
that's crazy.
So there's that. Then also you might see like they're trying to expand their market.
Yeah.
So it's like I can only produce so much, you can only produce so much, but between the two of us, we can produce for everything. So then they merge to expand into new markets or expand to more clients to a bigger client base. That's the big one.
And the thing is, when it comes to acquisitions, there's so many reasons why a company will want to buy another company. For instance, Microsoft and the Activision Blizzard one, they wanted to expand their video gaming thing. Their video gaming arm. Sorry, I don't know anything about video games. I apologize. I probably just insulted a lot of people.
So Microsoft has the Xbox. They have. So they're trying to expand that business. They're trying to expand in that business.
I mean, Activision. They do what? Is Far Cry is one of their games? Do they do Call of Duty? I have no idea. I'm literally just throwing darts at a dartboard right now because I don't know anything about video games.
So Activision's the Call of Duty games.
Yeah. So Call of Duty. I said that. Right? Yeah. Did they also do Far Cry?
The Diablo games,
that's right, Diablo.
Warcraft, so World of Warcraft.
That's the one, not Far Cry. Who does Far Cry? Whatever, I don't care who does Far Cry. But yeah, obviously Microsoft, they wanted to be the guys behind Call of Duty, and now if this merger goes through, Microsoft is they're now the guys behind Call of Duty. Yeah, they now
own it, so they make money off of all of the people playing in there and people who would consume in-game sales stuff. So all those things that you can add in, that's them. They get the gain, which you see with World of Warcraft. So subscription-based service that people are playing.
Oh, right, yeah.
So with a lot of the MMO online stuff, so massive multiplayer online games, you would see that, Microsoft has an interest in this because between their equipment, that's between their consoles and their computers, this is something that they want a piece of.
So think about it this way. Microsoft is buying Activision Blizzard supply chain. They're buying Warcraft. They're buying Call of Duty.
Mm-hmm. Guitar Hero.
Wow. I had no idea that was an Activision thing. That's awesome. I love Guitar Hero. But yeah, they're buying all that. They're also buying employees. So if they like Bob Kotick, the CEO of Activision Blizzard, who I think is a pretty good CEO, but they've been under a lot of fire recently because
they've had some issues in their corporate culture. Let's just call it that.
If they like Bob Kotick, he can now be he can still be the CEO of Activision underneath Microsoft, but he still has. But then from there, he has to answer to whoever the Microsoft CEO guy is.
Microsoft, yeah. No, so if this move works out, it will make Microsoft the third largest video gaming firm in the world, behind Tencent and Sony.
Yeah, so Microsoft is also buying their cash flows. They're buying their revenues. I mean, they're buying
the IP. They're buying the existing IP, properties.
Exactly. Yeah. All their assets, their real estate, whatever it is.
They're buying all their liabilities too.
Yeah, exactly. So that's why. I mean, you think about it that way. That's why a company would merge. They want to buy their whether it's talent, whether it's a cash flow, whether it's a certain asset, intellectual property,
a market,
all of those. The market. Yeah. So that sector, whatever it is, if they just really want Warcraft or Call of Duty because it's insanely popular, which it is, now Microsoft owns that. So congrats to Microsoft. Yep. Now, why would Activision want to sell? Or why would any company want to sell?
So why do sellers sell?
Yeah, why do sellers sell?
Well, let's put it this way. There's a profit motive. I'm going to say it's basically the profit motive all the way around for a lot of this stuff. So with a seller, 100%. You've got, think about this, because there's two types of sellers. There's the internal seller and the external seller. So at the small scale, you might have a business owner who doesn't want to actually run the business anymore. They've run the restaurant for 40 years.
They just want to enjoy the fruits of their labor and just, take their golden parachute.
Someone comes along and says, I'll buy the restaurant from you. I'll buy this, and this. I'll pay you this.
I'll give you $2 million.
And then more.
Wow. Yeah.
And you probably say, okay, plus it up so that you're paying the taxes for me and we're good. And you walk. So that's the easiest reason for a seller to sell. You have the owners who don't want to own it anymore. If you're a shareholder who doesn't want to own anymore, you can sell in the open market. But at the same time, maybe they're paying a nice dividend. You've seen nice capital gains on your investment.
At 100, now it's at 150.
So finally someone comes along and says, hey, I'll pay you not what the market's paying. I'll pay you more than the market's paying to get your shares.
Usually that's how it works.
And you would say, I like it. So that's the profit motive there. Why would a firm necessarily want to sell itself? Maybe a firm has been dealing with really, really problematic HR stuff and has had staff walk out a lot. So maybe there's a point now where management and a lot of owners and a lot of board members are saying—
I'm just talking really specific to Activision. But
I am. But maybe you have a board and you have board members that sit here and say, like, I'd rather have equity in this bigger firm instead of just this one.
There's there's the issue of like, okay, we have way too much debt. This company has a ton of cash.
Yeah.
Right.
So it could be it's a way to survive. It could be your board is your board is looking and saying, look, this is a good offer. They're offering to pay all of us more than what our current stake is worth.
Well,
usually, so like I said, it's a profit motive.
But usually it's always like, I mean, anytime a company decides to buy another company, it's a stock buyout. Like if you look at like T-Mobile
almost
and Sprint.
Always.
T-Mobile and Sprint. I got lucky. I held Sprint stock at the time and it shot up when they announced the merger. And they always pay more they usually always pay more.
So with that in mind, the seller's sitting here going, I have blank amount of my current stock. I'll be given more than that dollar value in the stock of the new company, which will be bigger and have a higher price.
Right.
Okay.
Exactly.
It's a no-brainer. It's everyone is served by it.
Yeah. Usually,
in theory.
Yeah. Usually, it's like that, right? Sometimes I haven't seen an instance where if a company's trading at $100 and it gets bought out by another company and they say, okay, well, we're going to buy it for $98 a share. I haven't seen that. I'm not saying it's never happened, but I've never seen it.
You probably wouldn't see it because the company would fight. It would become a hostile. A hostile acquisition real quick.
Yeah, yes, exactly. Yeah, I mean, but there's a lot of reasons. So I forget what movie studio. There was a movie studio that I think got bought by Amazon. And the reason why they did was, I think, one, they were facing some debt issues and solvency issues, but two, Amazon had the reach.
Hollywood Studios. So they bought Hollywood Studios, which was, prior to that, was called MGM, Metro Goldwyn Mayer, which is a theme park, or was a theme park in Orlando out at the Disney complex.
Yeah, but at the same time, like, I'm just saying, one of the reasons why you would sell is because this company already has distribution figured out. The one thing that's keeping you from being insanely profitable is distribution or whatever it is. I don't know, marketing, whatever it is.
I need what they have. I need their infrastructure. Mm-hmm. They need my equity. They need my section of the market. They need my sector of the market, whatever it is, right? And it's a hell of a lot easier for me to pay for you while you're a going concern than to try and buy you up when you fail.
Yeah. Oh, and I forgot to touch on this. Why someone would buy another company? If you can't beat them, buy them.
That's a big one.
Facebook and Instagram. So you can argue Google and YouTube.
And this does lead to a logical conclusion where eventually antitrust regulators tell you can't do it.
Exactly.
Which is why the Frontier Spirit merger is being looked at by antitrust regulators. Is this going to benefit the consumer?
I don't think they're going to have any issue with that. I think if United and Delta or something like that
would be a different issue.
Or if American and Southwest, because the first biggest and third biggest.
Right now, essentially, number 7 and number 9 are merging to become number 5. That's okay. If number 1 and number 3 are merging to become something absolutely massive, that's a different issue.
Yeah.
There's a reason that Nvidia's acquisition of ARM was being looked at by regulators in Europe, the UK, China, and the United States. That's a lot of concentration of talent and stuff in one spot.
Yeah. Let's move into how it kind of works, right? So usually whenever there's a merger or an acquisition, there's always some sort of investment bank. We did talk about the differences between investment banks and commercial banks, I think, and their practices, I think, 2 or 3 weeks ago.
3 episodes.
I've been so not gracious for such a long time that I just lose track of time.
It does seem to blend.
Yeah. It does. It really does. It was a couple weeks. It was a couple weeks ago, I think. And investment banks, they service a lot of merger and acquisitions deals. I think a lot of what they do is appraise other companies. They do their due diligence.
Yeah, they'll do a due diligence. They'll get in there and
they'll look at their cash flows. I just really want to simplify it by saying they appraise the other company. That's pretty much what it is.
It's an investigation and audit. That's all due diligence is I'm looking at this company, seeing is their stock price fair? Is this firm? Are these assets legitimately good? Do we need to put an impairment on some of these assets?
Yes, exactly.
What amount of this is goodwill?
Yeah, and then they turn around and they go to the buyer of the company, and obviously there's so much more to it than what I'm describing. It's a very labor-intensive process, but they'll go in there, they'll appraise the company that's being bought, investigate everything about it, a lot of boots on the ground stuff, and they'll turn around to the seller and say, okay, how much cash do you guys have? How much cash can you get in the near future?
How much stock do you want to do a stock? Do you just want it to be a stock acquisition?
Yeah, because you don't have enough cash. Then now you got to give existing shareholders of the company that you're trying to buy. Now you have to give them some of your stock or a preemptive right or whatever it is. I mean, they structure out all these different deals. They put some numbers together and they say, okay, this company should be valued at this much. If you want to do a 50-50 cash stock merger, this is kind of logistically how that would work, all that kind of stuff, right?
Oh yeah. So I mean, the steps in mergers and acquisitions. Why do I want to buy it? Why would they want to sell it? How much are we willing to agree on at the buy and sell?
Yeah, exactly.
Where's that equilibrium point?
Yeah. So let's just say this Frontier merger, it's $6.6 billion, right? It's a $6.6 billion merger that we mentioned earlier. Let's just say there's really only $5 billion in assets that are being merged. So if that were the case, in this scenario, there's an extra $1.6 billion that's not being accounted for.
So in a merger, we generally don't see that quite so much.
That's why I don't like using this example in a merger.
So let's purely acquisition. So
let's just go to the Microsoft Activision Blizzard. So how much was that? 65 billion? Sorry, 69 billion.
69, that's right.
69, nice. Yes, 69 billion. Nice, very nice. So let's just say Microsoft is really just buying $50 billion worth of assets. So there's this 19 extra billion dollars that's not being accounted for. Mr. Accountant, what would you call that?
So that's called goodwill. I look at the asset side of the board, I subtract the assets, or I subtract the liabilities from that number, and I say, I'm willing to buy all your assets. I'm willing to buy your company for assets minus liabilities, because I'm going to have to acquire your debt too, but I'm not going to pay you for your debt. I'm just going to accept that that's now debt that I have. And I'll pay you for the assets that exceed that amount. And then I'll probably have to pay you extra on top of that. And that's goodwill. I'm buying the goodwill of your firm. I'm buying all the goodwill that exists. I'm buying your IP. I'm buying your relationships with your suppliers. I'm buying your relationships with your employees, your relationships with your customers,
clients,
everything. I'm acquiring that, and I have to call it something. And I say it's goodwill. I am buying all the goodwill you have generated and created as a firm that's existing that I don't want to have to pay to develop myself.
Yeah, exactly. So basically, like from the accounting standpoint, there's got to be a credit and a debit side, and those can't be.
And they have to balance.
Yeah, they can't be different. So like when they value the assets, it's like, okay, well, there's the credit for the assets, but what about this other 19 billion? Would it be credit or debit?
At the acquisition of the firm, I debit all of the assets I'm acquiring. I debit the goodwill, I credit the cash, and I credit any liabilities I'm also acquiring. So yeah,
the goodwill and the assets are on the same side.
Yeah, they're all assets. The goodwill is an intangible asset.
Yeah, and the cash and the stock or whatever that's leaving, that's on the other side. Wait, so which one's debit?
That I would credit.
So that's credit, and then the goodwill and the assets
are debiting.
Gosh, it's dude. It's been
so everything
long
on the left. So everything on the asset side of almost everything on the asset side of the balance sheet is increased via debit and decreased via credit.
Yeah,
and vice versa over on the liabilities and equity side of the balance sheet. That a credit will increase that and a debit will decrease that. That is not That is not entirely true. There are certain things that exist on the balance sheet that operate in a different way.
Yeah,
but basically, I can say that's the case.
From the most simple perspective, that's just kind of how we like to bring it to your attention. But yeah, I mean, if you did hear something that was like a little bit off in what we just said, and you work in investment banking and mergers, feel free to let us know. I don't know that much. I've never worked in mergers and acquisitions, so I don't know. But I do want to talk about impairment.
So impairment is another accounting thing that we use. As we consume things, we either have depreciation, amortization, or depletion.
Yeah.
Go see the episode, folks, because I talk about that in an episode about a year ago, maybe. Impairment is how I write down a fixed asset for kind of a one-off, like something has happened. It's not something that was expected to happen.
Yeah.
So the way I would review impairment is if say I own land, say I have 100 acres of land and I've got a river and there's a flood and it washes away enough land that I can now sit here and say, actually, on my land, I only have now 98 acres.
Yeah.
I would take a loss for impairment. I would write down the value of the land because some of that land is now gone.
Would it also be a non-cash expense? Like the other?
Not necessarily. Yes, I'm sorry. In that sense, yes, a non-cash. It's me writing down the value of something. So it's non-cash in that respect.
Gotcha.
It will go on my income statement as a loss.
Okay.
Right.
But it's not a cash
loss.
So
I'll reduce my income in that respect, but it's not a cash loss. It's just
okay.
I have to remove the asset from my company, and I have to take it off the asset. I take it off the equity side of the board.
So would it be like? I mean, because I don't think impairments are exclusive to mergers.
Impairments happen in all businesses. You should be doing you should be periodically checking for impairment.
Okay. Because I know a lot of times, a company will sell themselves out to a bigger company, hoping that they don't do as good of a job in due diligence because there's some hidden risk. Yeah, there's some sort of hidden risk that they want to get rid of. Kind of like what's that? The Theranos.
That's huge.
Yeah, prime example of
if you sit here, that's a huge impairment. Like if I were to sit here and say, like, if someone were to have bought Theranos out at its peak stock, at its peak valuation, and suddenly realize that the IP was bullshit, like. You're going to have to pay. Like you suddenly have a huge impairment because all that goodwill is now gone.
Right.
The goodwill is worthless. The impairment is gone. Like or the impairment is now there. You are now having a huge loss.
And in that scenario, it's like, okay, I mean, Elizabeth Holmes, like she's dying to find a buyer because she knows that her product is worthless.
Now, also the great thing is after that, if the new firm who had purchased this found that she had been actively committing fraud, there are a lot of, especially since 2003, since Dodd-Frank, there's a lot of mechanisms to claw that money back legally.
Yeah,
because one of the big ones is any contract is both parties have to be acting in good faith, and if one party can be shown to be acting in bad faith, it blows up the deal, and you don't have to necessarily pay.
Exactly. And speaking of deals, so there's multiple types of deals when it comes to mergers and acquisitions.
Oh, yeah.
Yeah. So I'll just kind of breeze right through. It could be an all stock deal. It could be an all cash deal. It could be a combination of the two. So basically, if you own Activision Blizzard stock, for instance, and whenever Microsoft does buy Activision Blizzard, assuming that it gets approved, what's going to happen is if you own 100 shares of the stock and they say, okay, we're going to buy it for $95 a share, and the deal goes through, next thing you know, instead of the 100 shares you have of Activision Blizzard, you're going to have $9,500 worth of cash because Microsoft has bought the stock from you. If it's a stock deal, you'll have $9,500.
You'll have the agreed upon price
of Microsoft
dollar
stock.
Value in Microsoft stock.
Yeah. But it's usually like a share. Like instead of 100 shares of Activision Blizzard, this is the rate of exchange, right? So
there's an exchange rate. So
now that gets swapped out, and if it's not divisible or whatever, if it doesn't round out to an even amount of shares, then you get some cash for it.
Then you get some cash.
Yeah. Those are the types of deals that happen with mergers. You either get, if you're just a secondary market shareholder, you'll get some cash, or you'll get the stock of the new company. But the other types of deals I want to talk about, how a company does get bought out. So first of all, management buyout, is that the MBO? Is that what that stands for?
Yeah, so MBO, management buyout.
Basically, board members of a company, management of another company buys out a bunch of shares of the company they're trying to take over.
No, that's MBI. That's management buy-in.
Oh, so what's MBO?
Management buyout is that the current managers buy the shares. So they become owner managers.
Oh, so the current owners of the current
owners sell to the current managers.
Oh, okay, gotcha.
So the manager's buying out the owner and taking over as an owner manager.
Okay,
management buy-in is when an external management team buys the ownership stake and then comes in to manage.
Yeah, so sorry, that's a completely different type of buyout, whatever. Would that count as a merger?
Not really. It's just an acquisition. It's just changing owners or a divestiture.
But everything's the same. The company is still the exact same, pretty much.
Yeah, the company or the division is still exactly the same as what it was. It's just it's got a new owner, and it may have split off from the parent company.
So I guess an MBO or an MBI can really happen from not really anybody. It's got to be within. MBI is from an external manager, and then an MBO is the internal manager.
It's the current manager.
Okay, gotcha. And then so the next thing is a leveraged buyout. Could that also be an internal thing as well? Like one manager decides that they want to go gung-ho?
Usually no.
That's what I figured. I figured an LBO is always from an external thing, but I've never worked in an LBO deal. I've only studied LBOs. And to my knowledge, an external entity, they pretty much buy out the company, buy out the shares, whatever it is, and they say, okay, whoever I borrowed the money from to buy this company, this new company that I just bought, they are now the collateral. So it'd be like if I borrowed $200,000 from a bank, bought out a restaurant and said, hey, if I default on these loans, you can buy the restaurant from me.
Or the restaurant's yours.
Or the restaurant belongs to the bank or whoever, right? Whoever you borrow money
usually leverage buyouts, you see like a 90-10 debt to equity.
It's insane.
And that's exactly what it is. It's leverage buyouts are considered a little bit, maybe not cruel. It's because you're borrowing against the thing you're trying to acquire. And so it's very much like, hang on, that doesn't necessarily track if whatever you're trying to acquire doesn't want to be acquired.
Well, basically the sellers are selling to you against their own, unless they want to be. But normally speaking, an LBO, it's not quite like a hostile takeover, but
we're definitely getting closer to hostile.
Yeah, exactly. It's kind of I don't want to say walking on thin ice, but I can't really think of a better idiom.
Yeah, you could also do it with junk bonds, which is another thing.
Right.
You issue junk bonds, and then
I just like to think of LBOs as like you just big margin. It's like you're going 4 times leverage into one stock, hoping it ticks up or whatever it is. But the thing is, you actually end up owning the thing. And you have to hold it for more than a day. So that's how I make it make sense in my own head.
Yeah. No, it's essentially I'm borrowing against the thing I'm trying to buy.
And then you're using that thing
as the collateral.
Yeah, so if Microsoft was doing an LBO, let's just say this Activision thing was a LBO, which it absolutely is not because Microsoft has plenty of cash. But let's just say Microsoft had no cash and the bank, for whatever reason, did not want Microsoft stock as collateral. They would rather have Activision Blizzard stock as collateral for some reason. Let's just say that was the case.
Or rather bonds and Activision.
Exactly.
Say, okay, we're going to issue these bonds, acquire this thing, because you can't sell securities you don't have. But I can issue junk bonds.
Yeah.
Use that cash, but I secured these bonds against the thing I'm buying. So if I'm unable to make my payments on the bonds, well, they can't attack me. They can only attack the company I just tried to acquire.
Yeah. So they end up going after Activision Blizzard, which is a pretty extraordinary thing.
Yeah, they're not really all that popular, or at least haven't been in the last 15 years.
Yeah, I'm trying to think of the last time I remember seeing an LBO.
Yeah, but, I don't think I've seen one in a while.
Yeah, I'm not saying they don't happen because I feel like they do happen all the time, but it's usually private equity.
Oh yeah,
and then of course this kind of just is a great segue into hostile takeovers, my favorite thing in the entire world to talk about.
I mean,
aside from Pink Floyd,
fun.
maybe, but. It is fun to talk about.
Fun.
I mean, would I rather talk about Pink Floyd? Yeah, but I mean, I do like talking about hostile takeovers.
Yeah, so hostile takeovers are a merger both sides have to agree to, an acquisition only one side has to agree to. And technically. Now, in a lot of acquisitions, both sides
to agree to. It's much easier. Everything about it is much easier if both sides agree.
But sometimes they don't.
They don't have
and then you end up with with essentially a target and a
it's like a predator and prey.
Basically what it boils down to.
The predator wants to eat, the prey doesn't want to be eaten. Yeah, that's pretty much what it is.
It's a fantastic one. A really good example of this historically, just that I can remember recently, was Valiant Pharmaceuticals and
Bill Ackman in Pershing Square.
Yep.
So Pershing Square.
Remember, it was Valiant Pharmaceuticals at the time. They tried to buy Allergan, and Allergan rebuffed them, said we are not interested in being acquired. At which point, Valiant and Bill Ackman, who was a strong investor in Valiant and also an investor in Allergan, began the process of a hostile takeover, which did not end well.
Yeah, well, let's be honest. Hostile takeovers, it's kind of like the wolf and the rabbit, man. It's the rabbit is running for his life. The wolf is running for his lunch. It's not going to be easy on the wolf to catch the rabbit. And it's kind of like hostile takeovers. It ain't going to be easy. You're going to have to spend a lot of money in order to do what you want to do if you want to hostily take over.
Once it becomes hostile, it becomes a lot more expensive and a lot harder.
Yes, and this is where we start getting into the defense system.
Yeah, because there's different ways.
Think about it this way: a lot of preys have defense system. Turtles have turtle shells.
Turtles have shells. Rabbits are fast and can go under the ground. Rabbits can climb, or squirrels. Animals can climb trees. Squirrels can climb trees. Yeah. Dogs have teeth. Cats have fangs. Snakes have venom. Some things are poisonous.
Porcupines have whatever those things are.
Quills.
Yeah. What do you call those?
So
whatever. Yeah.
Once we've entered the point where we have a hostile takeover, or essentially the acquiring company has been told by the target company that they are not interested in selling to them, the acquiring company can do one of three things. Well, first thing is
there's more than three, but let's just do it. There's
three basic ways it goes.
Yes.
The company can say, "Oh, okay," and walk away. They could just say, "Never mind." And that was our episode. Now,
okay.
I'm kidding.
Cheers.
I'm kidding, guys.
Later.
I'm absolutely kidding. More next week. Now, the other two is it can either go directly to shareholders and try and buy stock, so it can try and buy enough stock to just or get essentially the shareholders to agree to vote that this is what they want. They want to be acquired, right? Personal profit. That's why they'd want to sell.
So that's kind of like in Wall Street, the movie Wall Street, Gordon Gekko with Teldar Paper, all right?
Mm-hmm.
Where he gets the
shareholders
to vote
Greed
against.
Is good.
Yeah, and he gets them to vote against the board members of Teldar Paper, and he gives a fantastic speech. Maybe the greatest speech in movie history, I think.
It's definitely up there. So there's that. There's going straight to the shareholders and telling the shareholders to make the board do what they want. Yeah. There's another option. They could also go in. So that first version is called essentially a tender offer. The other is a proxy fight.
Well, and this is how the company that wants to take over the other company, this is how they would do it. Sorry, I thought we were talking about...
This is how they'd force it.
Yeah, I thought we were talking about defense systems, but okay, but let's talk about,
that's well. Right. No, because we have to tell them how it's going to happen before we can tell them how to defend.
Yes, exactly. Yes. So
the tender offer
tender offer is going there,
going to the shareholders, asking them to back it. If they refuse, then you almost have to go to a proxy fight, which essentially you begin to buy the shares so you can replace management team.
Yeah,
we can replace the management team with your own guys who will then sell.
And then of course the last one is just secretly trying to buy shares of the company in the secondary market.
Yeah, there's just doing it because eventually you can just keep buying shares, and if you keep acquiring shares, one day you do just find yourself owning the company.
Yeah, it's like, wow, I have 53% of the shares. What? How did this happen? Generally speaking, I mean, you need billions of dollars to do something like that, but a lot of hedge funds aren't incapable.
And usually that would take a long time to prevent the price from rising too rapidly, to prevent too many people from going like, hey, why is this happening so fast?
Why are these guys up 25% in the last 2 weeks? Yeah.
Usually it's not a viable method.
Yes.
Which brings us, of course, to the really fun way to prevent hostile takeovers.
Yes. What are the ways they can defend against that? This is my favorite.
Which one is your favorite?
I don't know. I think I like the Crown Jewel one a lot.
Crown Jewel is a great one. I really like that.
Yeah, but okay, so there's so many different ways.
The Crown Jewel is legitimately is cutting off the nose to spite the face.
Yeah,
I love it.
So
it's a fantastic method.
Exactly. So basically, one of the ways they can defend against a hostile takeover is, okay, we know that this company is coming. So Microsoft and Activision Blizzard, we know that Microsoft, one of their big interests in Activision Blizzard is probably Call of Duty. So to prevent Microsoft from buying Activision Blizzard, if it was something that they wanted to prevent, they could just say, you know what? We don't want Call of Duty anyways. We'll sell Call of Duty to EA. Like trying to
yeah,
whatever. And make this hostile takeover EA's problem, right? So that's one way they could do it, right? You just sell your most price. Basically, the definition is you sell your most prized, or not your most prized possession, but your most, like the thing that they're after, the IP that they're after,
the crown jewel.
Yeah, the factory that they're after, whatever it is. You sell that out.
So what you do is the way that defense works is that when you're incorporating or when you do your bylaws, you put in there essentially a requirement that the moment a hostile takeover is initiated, you sell it off. You sell the reason they're trying to buy you. Dissuade someone, right? So it's that. It's the turtle shell.
Yeah, exactly.
Don't bite me. It's going to hurt.
But the thing is, I mean, most of the defenses against hostile takeovers is dilution, share dilution, I feel like. And voting right dilution is another way to call it.
There's two. Yeah. So the poison pill is the stock dilution plan, which essentially says the moment a single buyer or a single owner has acquired more than a pre-specified interest of the company being sought, that everyone except that buyer is approached and told, we will sell you more shares at an incredible discount to dilute the buyer's position. So now the problem is that dilutes everybody,
position. And that makes this. I mean, that really cuts the stock price down.
It drops your share price. It increases the numbers of shares outstanding. It does a lot of things. That's why it's called the poison pill. It hurts everyone.
Another way you can do it is it's not as poisonous as the poison pill defense mechanism, but it's similar, right? Where you do the employee stock ownership program, you pretty much have employees just exercise their rights.
Yeah, it's essentially because the employees are also major shareholders. Their incentives are aligned with management's more than in other cases necessarily. So the expectation is that the employees would vote with management to rebuff the offers.
But the thing is, upon them exercising their rights, like it dilutes the shares that the people that are trying to hostily take over the company dilutes their shares, right? And it keeps the shares close, So
another one and another method is differentiated voting rights, which you see that with Alphabet. Alphabet has Class A, Class B, and Class C, where Class A has 1 vote per share and is publicly traded. Class C has no votes per share.
Can't vote.
And Class B is not. Class B shares are held by original founders and original investors, and they have a 10-to-1 vote ratio.
Yeah, exactly.
So each share has 10 votes. So you can do differentiated voting rights in your shares that guarantee.
In that case, Gordon Gekko would have to go talk to those guys and convince those guys to vote against the board or whatever it is, in case if they did want to do a hostile takeover.
Yeah,
the thing about the poison pill too. I mean, I guess a lot of times a company will say, okay, if you bought stock before this date, if you held it for this entire time, you now have preemptive rights. And they can do that, right? Can they do that?
It'd be a lot harder to do that after the fact because it would be shown so not necessarily what you'll sometimes see is like a people poison pill or golden parachutes. You always see golden parachutes.
Yeah.
And essentially these are things that say like, so a golden parachute is the executive team essentially has written into contracts that if they're acquired and those people lose their jobs or if in the acquisition they're terminated, they're guaranteed these payouts. A people poison pill allows that during a hostile takeover, critical people are allowed to resign.
Yeah, so it's kind of like if you sign a 10-year deal with the San Francisco 49ers and they got acquired by the Seattle Seahawks, which will never happen, but just to make it easy for you sports fans, they don't have to honor the 10 years with the Niners by playing the last 5 years with the Seahawks.
Yeah, there's an opt-out clause. Yeah. And then, of course, my personal favorite, which is the Pac-Man.
Yes, this is hilarious.
So the Pac-Man Defense is where essentially you have a firm trying to take you over, it buys shares in you, so you turn around and start buying shares in it.
Yeah. And then now all of a sudden you have 10% of the votes in their company.
Yeah, it's my favorite example of this is in 2013, and it's where Joseph A. Bank tried to take over Men's Warehouse. Men's Warehouse rejected the bid, countered with another offer. During that negotiation period, Joseph A. Bank bought Eddie Bauer to try and gain more control of the marketplace. Now, because they'd spent the money, Men's Warehouse had the capital. They bought Joseph A. Bank.
So that's why they're the same company.
That's why they're the same company.
Yeah, which I don't mind. I mean, they're the same. I mean, as far as like the suit, like the quality level, it's about the same. I like Joseph A. Bank a little bit better.
No, I just think it's funny that they came for you, so you just turned around and took them over instead.
Yeah, sorry. I mean, no one was really asking for a review on Suits from me, but I just did it. I gave a review on Suits. So yeah, that's what a Pac-Man is. I think it's really funny that that's a way to prevent yourself from getting eaten up by a different company. It'd be like a wolf was chasing a rabbit, and then as wolf was chasing the rabbit somehow bit the wolf's ear.
Yeah, it turned out it was the rabbit from Monty Python.
Monty Python. That's
actually a vicious
rabbit.
killer.
Oh my god!
Absolutely.
I'm not kidding. That rabbit gave me nightmares, man. That was the ultimate Pac-Man defense, dude.
It was, isn't it?
Yeah,
that's great.
So why would that work though? Like, why would buying aside from if you actually can do it, right? Like if you can actually buy the entire thing.
A big part of being able to perform a Pac-Man defense is having the ability to actually acquire the initial acquirer.
I mean,
why would you do it?
I guess the main question I'm trying to ask is like, would the big companies see that their shares are being bought by this company that they're trying to acquire? Would they actually be like, oh my god, I got to protect my own board?
That's generally kind of the idea of the defense, is that maybe this company can't afford to buy a majority of your shares, but maybe you're a firm that has a minority veto.
Oh,
so 30% of your shareholders say that something shouldn't happen, it can't happen. So if they can buy 10% of your company and 23% of your company don't want to acquire them in the first place, suddenly 33% of your company don't want to acquire them.
That makes sense as to why that could be a defense mechanism.
Yeah, it's essentially it's that Venus flytrap, that boa constrictor. Oh, you came in, you thought you were going to get me, and I'll get you.
Yeah, no, and I can see why that would spook a bigger or not the bigger company, but whatever company is trying to go in and take it over.
Yeah, when your own existence is at risk, you might suddenly be.
Let's call it truce, and let's not be taken up like Joseph A. Bank. Yeah, that makes a lot of sense. But yeah, I mean, those are I think these defense mechanisms. The reason why I like talking about hostile takeovers is that this idea of defense mechanism, it's really ultimately playing chess, not checkers, if you will. You see what I did there?
I do.
Yeah. And speaking of defense mechanisms,
you know a great defense against the cold?
What is?
The Drunkenomics hoodie.
Yeah, we have plenty of hoodies. We have hoodies on.
I was going to say, and a great defense against having a boring laptop, you can grab a sticker.
Yeah.
A great defense against having a boring dog, you can get them a bandana. It's fantastic.
Yeah.
There's all kinds of defense mechanisms you can have out there to let people know who you are, what you're about, and that it's about hostile takeovers.
Yeah, and and the ultimate defense of having a boring hoodie selection, you can get hoodies in all kinds of Drunkenomics colors. So many kinds of Drunkenomics colors. And then from there, if you just have too many hoodies, and everybody you know has too many hoodies, you can always go to Patreon.com. That's patreon.com/DRUNKUNOMICS. How was that? Good?
It was awesome. Great. We just need to point out that it's drunkenomics.myspreadshop.com if you're looking for any of those defense against being dressed in a boring fashion.
Can't believe I skipped right over that. But then from there, Patreon, like I mentioned, the aforementioned link, after you've gone to that drunkenomics.myspreadshop or myspreadshop.drunkenomics.com link, you can check Patreon out. Help us do what?
Keep the lights on and the liquor cabinet stocked.
And the ice cubes cold. Yeah, all of the above. I mean, it takes liquid to stay liquid. So, and from there, play chess, not checkers. Don't brag, just say. Always fill and kill. Drink responsibly. And most importantly,
stay drunkenomical.
There you go. Cheers, my friend.